Hi, ladies and gentlemen. This is Steve Harney, the founder of Keeping Current Matters, and welcome to this week's edition of the Deep Dive. Now, this week's going to be a little different than what we've done the last several weeks. A couple of things. Number one is I promised you I'd be live from Dallas, and I lied to you. I'm not in Dallas. I'm in North Carolina in my lake house. I'm flying to the Tom Ferry event tomorrow. However, we do have Bennett from our team who's working this all out in Dallas. And more importantly, we have our guest, Jim McMahan, also here with us, and he is live from Dallas.
Right.
So Jim, say hello to everybody.
Hey, Steve, thank you for having me.
No problem. Now, ladies and gentlemen, with the interest rates, mortgage rates doing what they're doing, what I really wanted to do is bring in an expert to help us understand, is there other ways we can work this out? Is it just the 30-year mortgage is the only option? So we're trying to look at alternative ways of doing things. And so I was starting to think, who can I get to really help us with that? That's not my specialty. I want to let you know who Jim is. Jim has been a mortgage expert for over 30 years. He's the president of Benchmark, a mortgage company, one of the largest mortgage companies in the world. But probably the best thing I could say about Jim is everyone says, oh, our speaker's really great. Our speaker's the guy and all that. Here's what I'll say about Jim. When I decided to buy the lake house I'm sitting in, which was a very large investment, myself and my family, I needed someone who could help me through that process. I was self-employed. The property itself had some challenges. I needed to really have the best mortgage person in the country help me get this acquisition, which will be a generational acquisition for my family. And only one name popped into my head, and that was Jim McMahan. So the person you have sitting here is the person I go to whenever I have any questions about mortgaging, and I will give you a hint. Almost everyone else does too. They just don't admit it. All right. So to get started with, I do want to go over one thing real quick. And then we're going to break it down to almost a podcast between Jim and I. This is about alternative financing. What about arms, buy downs? There's a lot of cash deals. Are assumables even in the situation right now? So assumable mortgages? But I would just want to let you know that people are reaching out for alternative ways. If you look at this is the percent of all mortgages that are adjustable rate mortgages. And if we look all the way to the left, June 2021 through December of 2021, that stayed at 3.3. That was the average. That's that black dotted line across the bottom. Then when rates took off at the beginning of next year, more people reached out to get an assumable mortgage, a cheaper rate to start off with so they could afford the house they were really looking for. And as rates went up again in the middle of the year, actually September, October, the number of assumables went up. Rates stayed the same, but the percentage of assumables actually decreased. They didn't go down to the 3% they were prior to the mortgage rates skyrocketing. They're about double that, but they went down much lower than the end of last year. So Jim is here to explain to us why that's the case. And he's here, hold on one second. And he's here to make sure that, hold on, here we go. To make sure that we fully understand what options are available out there and what options are not. So Jim, let's start with the arms. Talk to me.
Okay. Well, great to see you, my dear friend. You all on this webinar obviously know Steve Harney and who he is and his fame, and we love each other very much like brothers. And thanks for that compliment. But the true just respect and love is because we both, I think, serve people well. We care a lot about this industry, about the people in it. Respectively, I'm in the mortgage banking world, Steve, in the real estate world, and we've been synergistic for a lot of our careers. I'm in year 37 of this crazy mortgage business. It's hard to believe because it's an every 30-day cycle, as we all know, and we're serving people well. And it's like run hard for 30 days, take a deep breath, and do it again. Someone asked me the other day with this unique Fed cycle that we're in right now, gosh, have you ever seen anything like this before? And I said, well, actually, I've counted in. This is my 7th cycle. So yes, I have. This was different though. And so I'm going to talk about that today as Steve prompts me. But on the adjustable rate mortgage question, in my selling days, and I was a pretty good sales guy. I loved this industry. I was one of the first guys to do, or people in my industry to do 100 million in a year in mortgages in 1998 in Dallas, Texas, 426 first liens. And I built a model around education and truth and a client for life model. And I did it a lot with adjustable rate mortgages at that time, because I was a big believer with the spreads in the yield curve, meaning fixed rates were this high, short-term rates were this high, and you could take advantage of that spread. A lot of people were afraid of ARMs back then because rates had been so high, they thought they could go back up. All that to say, in coming up with a truth strategy and presentation in those days, I showed people the why and how to take advantage of that gap. Today, Steve, ARMs have been an okay choice the last couple of years because yields went up quickly, as you know. Banks, for a while there, were offering some pretty good product. Currently, and I don't have a graph to show you, but you could show some of these graphs, the 2-year treasury, the 5-year treasury are actually higher than the 10-year treasury and the 30-year treasury. And so we're actually in what's called an inverted yield curve at the moment. And adjustables, I'm not afraid of them, and there's nothing wrong with them, because the ARMs that got everybody in trouble in 06, 07, 08 are gone. They've been legislated out with the negative amortization and your balance going up and all that. It's just today, when you look at rates, even though they're high, and we'll talk about that, I think finding a fixed rate loan at the moment, just because the spreads are so thin, that's why I sold an ARM, because you could take advantage of a bigger spread and a lower rate. If you can find one, if you got, a lot of money invested at Wells Fargo or Chase and their wealth development partner is great. They'll give you a prime based ARM, but most people don't have that option right now. If you're coming out of an ARM, we'll just talk about that for a moment. Let's say you're in year 3 of a 3-year ARM or year 5 of a 5-year ARM, and you're about to adjust. Don't panic. I mean, just go get your note out and read the index, the index, it's in black in one of the blocks, and then the adjustment. And then there's a paragraph that talks about caps. Some ARMs have a 2% cap. So if you're at 4%, you're capped at 6. That's a pretty good deal right now. Some ARMs don't have a cap until the year after the first adjustment. You just need to go read it. Have any mortgage professional with our company. I know we do it for free, but most will that are service hearted like we are. ARMs aren't a thing to be afraid of, but I don't know that I'd be running to find that be my main choice right now. There's other choices we can talk about today.
All right, let me just understand a little bit better, because you know it so well and you did explain it very well, but I just want to make sure I understood what you said. What's taking place now is the reason there was a difference back in the day between the ARMs, when you very successfully helped so many of your clients with it, is the ARM might be 2-3% lower than the fixed rate mortgage, because the short term treasury notes and those, they were lower, so you could borrow at the lower rate until your ARM was over, until the adjustable rate ended. Right now, the short-term rates, the 5-year, 10-year, are so high that there's really not a big difference between if you took an ARM out today or if you took out a fixed rate mortgage today. And it probably doesn't make any sense because they're so close to rates to even deal with the possibility of them going up at a later date. Is that what you're saying?
That's correct. For example, if you look right now on a website, CNBC or whatever, the 2-year treasury bill in the United States of America is pushing 5% right now. The 10-year is pushing 4.3. So the 2-year is 0.7 higher than a 10-year. That's a shorter term. So yeah, right now, what you just said is accurate. Adjustables don't have the spreads, to me, to make sense for a client as much as a fixed rate. And again, we'll get into some of the creative things a realtor can do right now. And I want to bring up too, you cue me when the timing's right, but builders are on fire right now, but they're spending money buying 2-1 buy downs, offering, these are just put out a big deal. We do business with them here in Dallas.
That's where I was going next, Jim.
Yep.
Let us know. I know you do a lot with builders, and I know builders are dominating the markets in most parts of the country, not only because they have the inventory. That's one big thing. They're building because there's not a lot of inventory on the existing home sale. But the other thing is they were very smart coming out of the gate, making sure that they made their product, desirable by actually doing buy downs. Talk to us about what the builders are doing, and talk to us what a smart realtor might be looking at right now. This
is a big, big deal, Steve, what you just said, because let's talk about this for a minute and then really translate this to what we're doing with realtors. Because we'll do $1 billion this year in just all new homes with builders, but the other billions we do is with realtors, and we're educating realtors on this. So, but let's talk about the builders for the last 12 months, because this is huge to observe. The top 6 builders in America hit all-time highs in their stock prices in July, because they do have inventory, but they got really smart. Last year they got killed. What happened is as prices kept going up, as rates peaked into the fall and late summer, tens of thousands of customers across America canceled contracts and were killing the builders in stock prices, because what was happening is builders had gotten wise in the spring when rates started going up, and they quit guaranteeing a price, they quit guaranteeing any rate. And all of a sudden, the normal husband and wife that had thought they locked in on a price at $400,000 were looking at a contract that was $520,000 if they wrote a contract in January, and all of a sudden they were getting an adjustment in August, and then rates had moved up 1.5 points, and they're like, I'm out. And some got their earnest money back, some didn't. And builders were stuck with this situation, but many of them wisely, and they had capital, and concrete prices started coming down, lumber prices started coming down. They repriced, they got them back on the market, they turned everything into specs, they bought forward commitments from lenders like us and others, and they all of a sudden came with the best rate and a decent price, and they sold every spec. I remember our builder division, I got an email in October dropping our December, which is usually a great month, projection from 190 loans down to 95 in the builder division. I thought, oh gosh, and then here we got in November, and the number got pushed back to 185, and we closed more than that in December, January, February. It was incredible because the builders repriced and came up with a strategy. Okay, well, we began at the same time to educate our realtor partners, because the market's good, we all know that, but maybe the prices that were just going parabolic kind of flattened finally and stabilized. And in some markets, even realtors were having to deal with their customers and say, okay, let's do a price reduction. We went up 40%, we need to come back down 5%. But we were educating on, hey, before you do that price reduction or any adjustment, why don't you think about turning dollars into an incentive? Let's do a 2-1 buy down, where with rates at 7.25, you offer a 5.25 rate for the first year and a 6.25 the second year. And simple slogan: marry the house, marry the property, don't marry the rate, don't marry the finance program, because you can have a professional like us that'll help manage that over time. And let's save the dollars now and get the seller involved in a transaction. And I'm telling you, we saw houses going like that when people advertised that in this Dallas market and some of our other markets around the country. We're in pretty much every market, as you said, with Benchmark. So that was the simple strategy we used. We copied the builders and have still done that. And it's been very, very successful to, if you've got the dollars built into the price, have the seller participate and you'll sell a house.
So you're saying instead of lowering the house by X amount of dollars in price, maybe the better thing to do is take that X amount of dollars and offer it as an incentive to buy down the rate, because the fear in the buyer hasn't been about the price, still isn't about the price. The fear in the buyer's mind is, why am I paying 3 percentage points more than my brother-in-law got a year and a half ago?
Yes. And then here's a huge point, Steve, is qualification. There is pent up buyers in this market. The builders have proven it to us. Sometimes they're in the middle of the market. Sometimes, the realtors and existing homes are owning the market right now. Builders definitely have that advantage just because inventory, even though they can't keep up. But here's a huge lesson in all this too, is qualification. The millennial buyer, the people that were just there back in February and March with a 5.75 to 6.25 rate are now going, okay, I got to wait again. You can do a 2-1 buy down. You can do it's called a 1-1 buy down, where you just buy down for a year, but you also can do a true buy down where you say, okay, mortgage professional, what does it cost to get a true 6.5% rate for 30 years or whatever number of years, 20 years for a customer, because the customer needs to qualify at that rate. Well, if it's 3 points on a, $500,000 loan and it's 15 grand, but you were about to lower your 650 house by that much, why not just pay that? And the points are deductible. There's just so many benefits to it. And now the customer qualifies at the 6.5. And they're like, oh, hallelujah, I can buy a house again. I couldn't buy one at 7.25 and 7.5. There's
All right. So Jim, I'm nowhere near as smart as you, especially when it comes to this. I'm not smarter than you in anything outside of maybe residential real estate. But on the mortgage side, you always blow me away. So I think I heard something that I don't believe can be true, but maybe it is. If you have a $500,000 house and you were thinking about lowering the price by $15,000, you could take that $15,000 and that would be enough to lower the rate from 7 to 7.5 to 5.5.
7 1/8 to 5 to to 6.5. I said.
Oh,
Yeah.
6.5. That's right. You said 6.5.
True buy down. Yeah, to jump to 5s, you have to do a 2 on buy down and 1. Those are temporary buy downs, Steve.
Right.
And the customer still qualifies at a qualifying rate. But if qualifying's a problem, I'm saying take the dollars and sit down. And I want to use a really powerful term that I use a lot. Premeditate your outcome. Realtors help your customer premeditate their outcome. Sit down with a mortgage professional and help them understand these are dollars not spent. These are dollars that put dollars in your pocket. And if a customer needs a 6.5, a 6 3/4, let's say it that way, to qualify, and rates have shot up to 7.5, find out, because everything, there's lots of parts, 45-day lock, 60-day lock, 30-day lock, they all have different prices, as you know. The customer sometimes doesn't know this, and especially the seller. But if you can get a professional like us that can help you premeditate this, and you can say, wow, we're willing to put in 15 grand, whatever it is, because there's percentages, as you know.
Right.
Most are 3%. So you can throw in 3% as a seller contribution on the purchase of a home, depending on the loan to value. Well, then find out what that buys and let's advertise that, because you're gonna open the door to more customers that can qualify at that rate, that are waiting for rates to come down because they can't qualify at the 7 1/4, 7 1/8, 7.5. I give that wide range also, Steve. This is why you've got to have a mortgage professional in the game with your top realtor. Is today's rates are swung, the tail is swung by not just money, it's swung by credit score, it's swung by loan to value. So you might as well get all that premeditated and educated ahead of time. This is why sometimes people get closings delayed and, oh, it's closing Friday. Oops, we need a week. They didn't premeditate. They didn't get all this stuff done up front. And education forefront with what it really costs, what a pre-approved buyer looks like. So I know I'm complicating a little more, but I want to give you the clear answer. You can do a temporary buy down, or you can do a permanent buy down, and you can premeditate what those dollars are, what the deductibility is, and what the maxes are that you can do based on the price of the home and the amount of the loan.
But basically what we're saying is, in a temporary buy down, they're qualifying at the higher rate, but
Right.
they're getting a break the first 2 years.
That's right.
All right. And this way, if they can get in there and get themselves working, and for some buyers, not every buyer, but for some buyers that just know they just came into a location and, they want to make sure that they're comfortable in their new employment before they start spending that new money that they got with the new job. That would be the perfect thing, because in 2 years, if they're not comfortable, they move from Pittsburgh to San Francisco. If they're not comfortable, they're moving back and they're selling the house anyway. All right. But the permanent buy down is for people that can't qualify now. They can turn around and the seller can help them with that. And probably the thing you said the most that hit me the most is, we're helping buyers if we do that. We're helping the sellers sell the house, because a lot of people are locked in right now. There's no question about it, because of the rate they have.
Yep.
All right. But there are also people that have to sell. So if a person has to sell and the market has them like curtailed now because the mortgage rate is up, they can turn around and take that extra money instead of taking a price reduction. All right, because a price reduction is going to get lost with all the other prices. But
Right.
if you can advertise a house saying this house has a 6.5% or 6.75% mortgage versus the other house that is a 7 1/4% mortgage, that number 7 at the beginning really impacts buyers in a tremendous way.
Huge.
It's a psychological move almost, so,
And,
but it also benefits them.
I like to look at it as you go into a battle in this marketplace today. Have you checked all of your weapon systems? Do you know all the weapons you have available to you? And most people don't. And you have the best of the best realtors out there, the Tom Ferry folks, and I respect those guys a great deal. Known them for years. You're the best of the best. Make sure you know all of your weapons and tools that you have in your tool belt to go into the marketplace, because you can attract more buyers with some education and having some mortgage strategy ahead of time.
All right, cool. So that's already, ladies and gentlemen, what we've established is what? The assumables, which were hot at the beginning of last year, all right, because rates shot up and there was a spread. Now there's not as much of a spread because it's not as much.
You said assumable. You said assumables? You meant
No, I
adjustable?
mean adjustable rate mortgages. I apologize. Thank you for correct. The arms they jumped into. All right. And now that might not be an option, but that brings me to, and with them, the buy downs might be a better option. All right. And that's what Jim just explained. Please find the mortgage professional you're dealing with. Please hook up with that person and make sure that we understand what's the term? Premeditate what that buyer is going to do. That's what KCM stands for. We go in it with the heart of a teacher. We say that all the time. If you're a KCM member, you have to have the heart of a teacher. What Jim is saying, he teaches. He teaches his clients. He teaches his realtors how to teach his clients or their clients. So it's really, really important that we do that right now. But the reason Assumable jumped into my mind, Jim, I'm starting to hear here and there talk about, different people, and that I haven't heard the word assumable mortgage in over a decade. But now it's starting to pop up again. Talk to us a little bit about the availability of that and how that works.
Yeah, some of you on the call will laugh at this. Steve and I were talking in the pre-call. My dad was a Section 21 agent for years when I was in high school and college a long time ago, and then a RE/MAX agent for years. But early on, when I was young, I remember those assumptive contracts. It was such a standard deal way back when with FHA and VA and stuff, and even conventional. Today, the assumable loans haven't been talked about forever, but let's catch up on that. Again, it's if you want to find out, you go to your customer, you're doing a listing. Hey, I think my loan's assumable. Give me your closing package from a few years ago. Let's pull it out. Let's have a mortgage professional look at your note, just a simple real estate lien note. They'll go in there and find assumable, the paragraph, the index, find all that stuff, highlight it, talk about it. Most loans, if they are assumable, they're assumable with a bank or a current lender, and they adjust to a current market rate. So it's probably not worth chasing that. FHA loans changed a long time ago to, going to a market rate. The one loan I can tell you for sure that's still an assumable loan and actually keeps the rate is a VA loan. With so much equity built out there, it didn't make sense usually. But again, the prequel, my CFO walked in and told Steve and I that currently in our portfolio benchmark, we have 12 active, which is unbelievable, 12 active VA assumptions happening right now. He went and looked it up in our computer out of our portfolio. And that's because, say, a veteran bought a house a year ago, and now they're selling. They can advertise that as an assumptive loan. And if their rate's at 3 3/4, someone is assuming 3 3/4. Now, the catch is they do have to qualify. It's not a non-qualifying assumable like many of them used to be, but it is the rate. Obviously, they have to already check for the equity that you agree upon, subject to appraisal and all that. And then the veteran, the only note I made, Steve, is the veteran doesn't get back his full eligibility until that loan gets paid off or sold. But sometimes people have done something else or that kind of thing. But there are VA assumable loans out there. Other ones that are assumable, you've got to read the note. You've got to check with what the conditions are on the deal.
Okay, so let's just take a look at that for a second. So if a person returned from overseas, having been called over, did his job, she did her job, she comes back, she uses her VA benefits to go ahead and purchase a house. And they purchased a small house, and then all of a sudden they became pregnant. So now they want a little bigger house. So the loan that they have on that original house is assumable because it's a VA loan. And probably since a person could assume it, and I like the fact that you said they have to qualify, because the days of people not qualifying for a loan, I hope they're long dead and gone, because that led us to another challenge back in 2008. So that doesn't bother me that you say that. I'm happy you say that. But if a person qualifies for that 3.5% or 4% loan, then what winds up taking place is they have to come in with the extra cash. The buyer would have to come in with the cash that house appraised. All right. And then they would assume that loan. And probably my guess, ladies and gentlemen, and I could be wrong about this, that house could sell at a premium based on what the mortgage rate is. So like you could ask for more money for that house because the people are getting a 3.5% or 4% mortgage than you could for the same exact house across the street that they have to pay a 7% mortgage rate. So what we want to do is, especially in our communities where we have a very strong military presence, we want to make sure we're talking to those people that we sold houses to recently and just find out, even if they're not talking to us, call them up and say, I don't know, but you might be sitting on a gold mine if you're thinking about moving anytime in the near future. The rates might be scaring you away, but I think I have a way to get you extra cash out of your house because we could sell it at a premium. Now, that's something every single one of us should start thinking about. I know we're not as busy doing as many transactions. I get it. There's no problem with that. So we have a choice now. If we're not as busy doing as many transactions, we can take that extra time we have and whine and complain and cry and say, oh my God, this is horrible. Or we could put a plan together to say, how can I help more people through these times?
Right.
And if we put a plan together, as Jim was saying, let's open our minds to all the different possibilities. And again, I'm thinking about, some of the agents we have in military communities. I would think that there is an opportunity there, not only to list a house, but to start conversations about real estate. Using that as the opening conversational piece. So that's important. Now, going into the last part, Jim, we did say that they could assume a mortgage, and we did say, well, if they bought a house a year and a half ago, and dependent on where they are in the country, that house is now worth probably 40%, 30% higher than it was 2 years ago. All right. So now they have to come up with a lot of cash. But what we're seeing now is the number of cash sales of all sales is up to 26%. 26% of all the existing home sales that sell are now cash sales. That's an all-time high. Everyone's assuming they're investors buying houses, like Wall Street's coming in. In reality, Wall Street is buying less and less houses. Many companies are selling their houses off now. So that's not what's making up a big portion of that. What's making up a big portion of that are people helping their children. All right. Now, an all cash sale, that's tough, given for the whole cash sale. But I will tell you that I just read this morning, so I didn't read the whole report. I didn't read the whole study, but the basis of the study was 40% of the buyers under the age of 30 that are buying a house right now are getting down payment help from their parents. 4 out of 10 buyers under the age of 30 are getting down payment help from their parents. So let's talk about the assumable. That's where they could get that cash from. Their parents could come in, instead of it being a down payment, it would be the difference in the money. And they're having a, now, how did the parents even get that cash? Well, is that even a good idea to do, to ask your parents for $200,000 to buy that condo? Well, what's your thinking on the old cash sales?
It's fascinating listening to you and just thinking about all the things that have happened the last few years. I want to preface my answer with this. I love this industry. When I discovered it in 1986, I did my own homework. I'm a numbers guy, and I realized with my homework that 42% of this great country's gross domestic product, GDP, or our economy, is based around housing finance, and all parts of it, right? Job security. And never thought about the stress and all the ups and downs, but here we are in 2023. And we get to be a part of, really the greatest phenomenon of all time, home ownership. And you just talk about families, parents, really grandparents too, because we see that a lot, Steve, and the cash phenomenon. But what's led us to how solid the marketplace that we're in right now, because believe me, folks, the Fed has tried hard to whack this housing market to get what they want and shake the trees out and get inflation down, which has come down quite a bit. We should wrap with that in a few minutes, but it's fascinating because they've not pushed us to any kind of default negative situation at all in this country, even with rates rising the fastest. And by the way, we should do a song and congratulatory confetti, Steve, because the group of people, professionals listening today, have successfully made it through the fastest rise in any 180-day period of interest rates in recorded interest rate history. Right? I mean, I have graphs back to Alexander Hamilton in 1796 when he funded the first Revolutionary War bond, right? And rates have never moved this quickly, and we've gotten through it. We're topping out now. But the reason is because there was a cash component in 18, 19, 20, and 21 that was unbelievable. In some markets, 30%, I read, but like you just gave us that overall stat of 26%. And so you don't have defaults right now. They're like 1.4% nationally. It's right where they're supposed to be. There's always, in my education over the years, there's always 1% of people defaulting because somebody's dying, getting divorced, or something happened, right? So we've got an amazing marketplace. We have 50% loan to value in this market nationally. If you take the gross value of residential real estate, minus the debt, it's a 50% loan to value. It was 76% when we crashed in 08. It's unbelievable how strong the real estate market is right now, Steve. So the cash component is a big deal, and even our industry has shifted to it. We see constantly, we even have a letter called Gift of Equity. It's a form that parents or grandparents fill out. You have to source where the money is. You have to source how long it's been there, because there can be games, but it many times is more on the parents. That was in the parents' account for 90 or 120 days is where the rules are now. And then showing that it's sent over to the kids and it's not a debt. It doesn't have to be repaid. I mean, obviously families work stuff out over time, but for us, they can't have a debt. But that's a big, big part of home ownership today with where prices are. And I don't think that's going away. So that's my take on that. But ask me any specific question on that from a regulatory standpoint or anything, I think I can answer it.
Yeah, well, I think two things. First of all, we promise everyone we're going to get them out of here in a half hour. So we got a minute, so we can't go into the inflation, but maybe I'll have you back to go through that. And I'll bring on our economist also, because he loves to talk about inflation and what's happening too. But by the way, that study that I haven't read yet, I just read like a preliminary abstract and the conclusion, also talk very much about grandparents. Grandparents are a big player in that. So you're right. You got that touch right where it's got to be. But they really shouldn't get it all cash. Like I've always learned that a mortgage is a tax deduction. All of that situation, you can play that to your advantage. And that's why homeownership is so popular here in the country, because you do have tax advantages, all right, from the mortgage deduction. Now, if they buy it all cash, they lose that tax deduction, right?
Right.
So they don't need all the cash from their parents.
Yeah, so there's a term called acquisition debt. So when you buy your homestead, the debt you take on at the time of purchase of homestead is called acquisition debt, and the IRS treats that as fully deductible interest, obviously subject to your tax bracket, blah, blah, blah. If you pay cash for a home and then borrow cash back out 4 to 6 months later, 2 years later, there's still deductibility, but it's a percentage of based on tax bracket. Your CPA can give you the total details. So yes, the deductibility is pure and much better at the time of purchase. So if you could do the math with a CPA or with the family, put 20% down, borrow the rest, as long as you can qualify, that's wise. And again, because you can always refinance that, no cost refinances, all that come along. The only thing I will say on the yield thing, because I won't get into the inflation stuff, but this is a huge point for you realtors.
Sure.
Rates peaked exactly where we are right now. In November of last year, we were hitting the mid 7s on rates. Inflation was running at 7%. We're at 3.7 now. We've fallen almost by half, and the Fed has pushed us back up through words. I don't think this will last, Steve, because how does that work, right? Where inflation's on its way down and has dropped by half since last fall, and yet rates are back where they were last fall. Doesn't make sense.
All right. So he's giving us some real good promise, and I guess we'll end with that. Jim, thank you so very, very much for your expertise, your understanding, your insights on everything that we're doing. And basically, if we recap, the adjustable rate mortgage might be for some, but probably not for many. The buy down seemed like something that we should really learn and get some good education on from a mortgage professional. And I will make an argument that if your mortgage professional hasn't already brought this to you, maybe you should think about finding a different mortgage professional.
Yeah.
All right, because they should be educating you like Jim's people do. But we have the buy downs. There is some assumability, especially for people in military communities. You might see more of that because they tend to stay at home when they come back. All right, so let's take a look at that. And as far as the cash deals are concerned, parents and grandparents for centuries have helped their kids out with college tuition and everything else, and they're helping them out with houses now. So let's keep our mind open to that also. Jim, again, thank you so very much for taking this time. A person of your prestige, and I know how busy you are, taking a half hour and helping our agents understand that. I appreciate it.
No, it's my blessing, and go make it happen. This is the greatest opportunity, Steve, as you and I know, for the professionals on this call to go make a difference that lasts for families. It's wonderful. It's the greatest blessing we get.
Right. And I'll double down on that and just say, Jim's 100% right. Well, most people are crying about what's happening. Most agents are crying about what's happening. If you're helping people during this time, those families will remember you forever. All right, this is when they need the most help, not the least help.
Absolutely.
All right. Thank you,
My
everyone.
friend.
And I'll see you next Monday, 11 o'clock Eastern, 8 o'clock Pacific. And we're going to cover the situation of inventory. That's our next thing. How do we build inventory? And we have a pretty good session coming at you. So see you next week.